Hey everyone, we're gonna begin shortly in 2 minutes. Just gonna wait for a few more people to come in, and then we'll begin. Okay, I think I'm gonna start. Good morning, good afternoon, good evening to everyone. Thank you for coming to today's session. Today's session is part of a series of educational webinars by Vantage. My name is Sherman, and today we're going to talk about stochastic trading strategies. So before we begin, I just want to highlight that any of the materials that we're going to cover today, do ensure that they are in line with your own trading objectives. If you do need external advice on trading, do ensure that you seek them out and fully understand that trading FX, CFDs, or any sort of derivatives contain risk, high risk, and make sure you fully understand the risk before trading them. Okay. So today's agenda, pretty straightforward. We're going to talk about some of the trading strategies using stochastics. And even before that, I'm going to talk a little bit on the introduction on stochastic first, and then we're going to move on explaining what stochastic divergence is all about. And I'll use some examples to talk about how we can actually incorporate stochastic trading into our trading. Okay, so there was a prior webinar on stochastics, but I'm just going to quickly go through what it is, some of the components that make up the stochastic oscillator. Okay, so basically it's an oscillator that we usually use to determine momentum, right? The stochastic oscillator basically has two important components. One basically is the upper and lower bound, which most of you might be familiar with. One, anything above the stochastic oscillator contains a value from 0 to 100. From 0 to 20, that's considered the oversold region, where we can see that prices are usually going lower, and people consider that as the oversold region where there might be an opportunity to buy. And then the region from the 80 to 100 is usually the overbought region where people tend to sell at that level. I will also deep dive into why it's not always a sell in the overbought region. It's not always a sell in the overbought region and a sell in the a buy in the oversold region. Okay, so it can be combined with your key graphical levels or your key support and resistance level, and any of your trend indicators that will identify your breakout opportunities. It's usually used mainly and effectively in ranging markets, but they can also be applied on your trend markets as well. Okay, and do know that in trend markets, your stochastics, once you understand what makes up the stochastic values, how you calculate them, you will know that in trend markets, they can tend to stay in overbought and oversold regions for prolonged periods. And if you're going to buy in oversold regions or sell in overbought regions during this period of time, you might incur high drawdowns. So we want to talk about how we can avoid that and how we can actually properly use the stochastic indicators. Okay, again, this will only be a 30 minutes webinar. So if you have any questions along the way, feel free to put those questions in the Q&A or in the chat. And as we go along, if I see any of these questions, I'll try to address them as soon as possible. Okay. So one key thing about the stochastic indicator is that despite the trend, so whether is it an upward trend, a downward trend, or a sideways trend, most of us will think that the stochastic indicator will tell us when or where to buy or sell. But in fact, in any of these three trends, right, there's only three trends, one up, the other one is down, and then the last one is sideways. Your stochastic indicator might show the same thing. So we do need to know what the stochastic indicator represents, what's the underlying component, and how we can actually use them to trade. Okay. The stochastic indicator, it's the main use of it is to determine the momentum. And when I talk about momentum, it's basically the rate of change of prices. Okay, so a lot of these indicators or oscillators, what we're actually measuring is the momentum of price. Okay, so it scales from 0 to 100. Anything above 80 is considered an overbought region, which means that it tends to be a region where there's a lot of buying, and once you enter this region, people consider it as overbought and are ready to sell. The lower bound, which is from 0 to 20, is considered an oversold region. So when prices people are selling a particular instrument and it enters a oversold region, people tend to say consider that as a buy zone. Okay, but a more accurate representation of these two areas is that when it's below 20 or in the oversold region, this usually indicates that this is an exit of your potential bullish signal, and then anything that more than 80 is an exit of region that signals a potential reversal. So if you are buying in a bullish trend, right, when it enters stochastic above 80, it's usually a signal and an indicator to tell you that buying momentum is at the highest right now, and we should not buy at such a premium price. And vice versa, when we are selling in a bearish trend, when it enters below 20, it usually tells us that the momentum of the sales are at its highest, and we should look to reduce our selling entries. In most cases, there is a SMA line that comes together with your stochastic indicator, and the most commonly used value is a 3 period on the daily time frame. I'm going to dive a little bit more on how we can actually tweak this value later on, right? How we can tweak this value to apply to the appropriate time frames and appropriate trading periods. It doesn't always have to be 3. It can you can change this value to suit your trading style and the time frame that you're on. Okay, so just for those who are not familiar with the stochastics again, right? So this is basically a price chart, right? Whenever there is a huge sell, right, your stochastic will tend to move towards the lower levels from 0 to 20, and this will be considered your oversold region. And as prices move back up again, when momentum of the upward pressure is there, your stochastic will move up as well. And basically it oscillates between 0 and 100 as prices move, as long as there's volatility and as long as prices move up and down, right, oscillator will reflect that move accordingly. Okay, so again, to really highlight on stochastic, a lot of people look at stochastic as a indicator to predict price direction, but in fact it doesn't tell you the direction, it just tells us the momentum in which it is moving. Okay, so if you would use an example of 2 cars on the road, right, basically the speed that you're going on the speedometer, which represents your price, right, if let's say this curve which is at the back, it represents the price X periods ago, depending on the value that you put in it. Again, a commonly used value is 14-day period. And then there's another price that you look at right now, which is the current price, right? If it's in front of the previous price, the price itself is basically the speed at which you're going. The stochastic measures the rate of change in which the second car is moving away from the first car. Okay, so it's telling us the rate of change of price. Okay, and if the rate of change of price remains the same, that means if these two cars remain the same at the same speed, there's no rate of change, then your stochastic will show little or no movement. Okay, so for your stochastics to actually move from, say, a lower value to a higher value, it has to change the rate, as in the rate of change has to increase or decrease to show or reflect in your stochastic indicator. So it's very important that we're actually measuring momentum, not the direction of price. Okay, so if let's say the current price move from T1 to T3, right? There's a change in terms of the rate of change. Then you see stochastic value moving depending on whether or not is it moving upwards, or is your price moving upwards, or is your price moving back downwards. Okay, so the stochastic compares your current value, which is basically price at T1, T2, or T3 against the price X periods ago. And of course, we do have the SMA value, which helps smoothen this the stochastic curve, such that we are not just relying on a single point, but rather the average of a series of points. Okay. Why is that important? Because if you're comparing against a single point, the data or the signal that you're getting will be very sensitive, and it might lead to false signals. By smoothing your stochastic values, you're basically looking at the average, which means that there's less chances of false signals, and you're actually, it's sort of like a wisdom of the crowd, right? You're getting an average of a range of values, and then once the average is above 80 or below 20, that signal will more likely be consistent and reliable as compared to just one single point. Okay, so another important thing about the stochastic indicator is the divergence of stochastics against the price. Okay, so since we are already measuring the momentum, right? So if price move in a similar trend, but the stochastic value is somewhat lesser than its previous value, then it sort of signals a bullish divergence. And similarly, vice versa, if prices are moving upwards and your stochastic is measuring a lower value, then they'll be signaling a bearish divergence. So on a graphical form, this is what happens. So this is a price moving downwards in a downtrend. As your price make a lower low, right? The idea is that your stochastics, since we are measuring the rate of change, if your stochastic mark a lower low as well, then your rate of change as well as your price change is in line with each other, right? But if your price makes a lower low, but your stochastics make a higher high, right? A higher low, right? Then we'll say that this is a divergence. So prices move down, but the momentum is lower. The momentum is lower than what it was previously, and hence this is a signal of a reversal. Okay, so similarly, you do not really need to have the stochastic out to determine a divergence, right? So basically what you want to see is that this value here is determined by the difference in price of this upwards move and then this downwards move versus this upwards move and this downward move. So as you can see, this downward move is of greater magnitude than this upward move, probably about 1.5 times this upward move, whereas for this, it's roughly a 1.1 to 1.2 times downward move. So the momentum actually decreases based on this leg down when we compare that against this downward move. So once we see something like that, it's usually an indication or a signal to tell us that sellers are exhausted, and this might be a time where there's a reversal that's going to happen. Okay. So let's use some examples and look at how we can actually put that into practice. Okay. So I think one key thing before we actually begin the looking at your stochastics, right? It's basically to tune your look back period. So some of us, we are basically going in and using the default values of like 14.33 or 10.33, depending on whether you're using TradingView or your MT4 or MT5, right? But one important thing to actually begin is to look at your look back. Okay. So based on your trading period and time frame, so the default, right? When you talk about your default values of stochastics, most people will use a 12-day look back on a daily time frame. Okay, 12-day look back and a 3-day SMA. And why is that so? Is because especially for FX, you might use it for equities, might use it for other instruments as well. But for FX, because events actually announce every other week, right? So when you look at a 12-day look back and a 3-day SMA, what you're actually comparing is the current price against 2 weeks worth of data, as well as the changes that you're seeing, the average rate of change for every half a week. So one is the time frame, which is a 12-day look back, which it's basically about 2 weeks worth of market movement, as well as a 3-day, which is looking at every 3 days, what's the rate of change that we are seeing in the market, and sort of comparing that rate of change. Okay, I do have one question asking if the RSI or stochastic is better. So again, for all oscillators, both RSI and stochastics are oscillators. They are both measuring momentum. So there are actually two different names for measuring the same thing. So both of them are actually measuring the rate of change. So it doesn't really matter which one you are using, right? They will actually give you the same conclusion. Just that you need to take note that RSI, the definition for oversold and overbought region, it's 70 and 30 as compared to stochastic, which is 80 and 20. And why that is so is because the calculation for stochastic is more sensitive. So values tend to move towards 80 and 20 more often as compared to your RSI, which is usually less sensitive. And the overbought and oversold region usually tend to be lower or nearer to the mean, which is 50. Okay, hope that answered your question. Okay, so the other way in which you can actually take a look at tuning that look back is that if you're trading on a 5 minutes time frame, right? It doesn't not that it makes sense to use the same default 3 days 12 look back is basically your K value, and 3 is basically your D value. Okay, 12 being your stochastic comparing your current price against the price 14 periods ago, versus the 3-day SMA, which is your 3 days average of your stochastic. So when you're looking at 5 minutes, right? If you do a 12 period look back for K, what you're basically doing is that you're looking at the comparison of your current price against what happened 1 hour ago, right? And if you look at FX, say even in the Asian session, right, you don't really see much movements or much volatility in the Asian session. It makes sense if you want to trade very frequently during the London and New York session to use the 12 look back period. And again, there's no right or wrong to this number, but if the lower the number, the lower the time frame, and the lower the look back, it means that you get a lot of signals, and most of these signals might be false signals. Okay, so it's up to you to tune it, but if you're looking at a 5 minutes time frame, what you want to compare, which I think is sensible, would be a 48 period look back, which is roughly 4 hours, right? Because 1 hour, there's 12 5 minutes intervals, and then 48 will be basically across 4 hours. Why this is a much useful look back is because if you start in the London session with a 4 hours look back, you're looking at the rate of change or the movements prior to the London session during the second half of the Asian session. Okay, and when you're in the New York Open, you're basically comparing the New York Open prices against the start of the London Open and what has transpired and what has changed during this period. The smoothing can be how frequent you want to trade using this oscillator. So for example, if I use a 12 SMA for my stochastic on a 5 minutes time frame, it means that for the last 4 hours, I want to look at 4 different trading opportunities, right? Whether it's a buy or sell. And the definition of a buy and sell would be your higher time frame trend. So if I use a 12 period SMA, basically I will probably have at least 4 different opportunities to trade during this period. Okay, because if you look at the oscillator, right, it oscillates from 0. Rarely you'll see like given a appropriate K value, rarely you'll see a prolonged period of the stochastics at a single value. So it usually oscillates between 0 to 100, 0 to 100. Rarely you see during the active trading times to have something like that, where prices remain relatively the same and you have stochastics hitting the same value over and over again. Okay, so of course, when you see such a market, right, when there's little or no volatility, it's very hard to trade using your stochastics because you need the volatility to basically make all the movements to actually make money, right? So you will try to avoid times where the market is flat or any instruments that tend to be flat. Okay, usually instruments that have low liquidity, like some of the crypto altcoins, but for forex, you usually have a lot of liquidity. So during the London session or the New York session, you see a lot of volatility, and you can use stochastics to trade them. Okay, so with a 12 period SMA, you're basically comparing the average rate of change for the last 1 hour. Okay, in most cases, people will actually use the blue line is actually the stochastic K value, right? It's looking at that one point in time. So basically this current point as compared to my previous price of X period, which in this case is 48. I think it's too small here, you can't see it. But basically for this stochastic, I'm actually measuring the price right now to the period, 48 periods before this. So this is a 5 minute charts, 48 periods, it's 4 hours ago. Okay, some people might trade the blue line, which is the stochastic value. But again, I would say that since you're only comparing one single point, right, it tends to be very sensitive and it might lead to false signals. So a better, I mean, I wouldn't say it's better, but if you want to avoid false signals, then you might trade the when the orange line, which is the SMA line, is above 80 or 20. And I also want to highlight the normal convention. How do people actually use these two values, these two lines? They only trade during the crossovers. So if the blue line cross in the overbought region, when the blue line falls below the orange line, they call it the stochastic crossover. That's where they do a sell. And then in the oversold region, when the blue line moves above the orange line, they consider that as a buy opportunity. Okay, but it's this indicator just measures the momentum. You can use it any way you want it. In this case, if you look at it, if whenever the orange line it's above 80, you do a sell, you see that it's actually valid for those entries. So for example, if this is the start of my trading period, right? This is my London session, right? I wouldn't have sold here because this was measuring what's happening in the Asian session. So I do know that this value is the highest. This is the start of the London session. I know that price is the highest since the beginning of my Asian session. So what I sell here, I wouldn't do it as a confirmation, but it's just a good way to know. Okay. So as time progresses, when the orange line approaches above the enters into the overbought region, I do know that at this point in time, right, because price has already moved lower, but the momentum here is almost similar to what I experienced at the start of the session. So I do know that the momentum is the same. What is likely going to happen because of the difference in price is that price would tend to move down again. Okay, so what conclusion I can draw from here is that the upward movement, this upward movement here, is almost similar in terms of the momentum and strength from the Asian session to the start of my London session. So this gives me a good opportunity to sell. And again, as it goes down, price falls below my previous entry and is almost at the overbought region. I can do a sell here for the next leg down. Okay, so one question on the daily time frame and what setting we should use. The standard values would be 12.33 or 12.31. And then as long as you understand what this 12 and what this 3 means and what kind of data you're comparing, it can be any value. So if someone wants to trade, the frequency of trade is roughly once every month, then he might change this on a daily time frame. He might change it to say 20, since there are 20 trading days, roughly 20 to 22 trading days in a month. And if he's only going to trade once a month, you can change this to 22. Okay, but if your frequency of trade is higher, that means you're like a full-time trader, you're sitting in front of the computer most of the time, then on a daily time frame, you can even look at 5 days look back, because since the events are happening week on week, right? You can do a 5 days look back to increase the number of signals, and then the average can be 3 days as well. And if you're even more frequent, you want more frequent trades, then you drop down to the lower time frames, maybe the hour or the 4 hour, and look at the respective look back. So on the 1 hour time frame, I would usually look at. Okay, let's talk about the 4 hours first. Okay, so for the 4 hours time frame, I will usually have a look back of at least a week. So one day there'll be 6 4-hour periods. 1 week there'll be 30 4-hour periods for the 5 trading days. Okay, and for the 1 hour, I'll look at the 3 days look back. So in a single day there'll be 24, and then for 3 days look back there'll be 72 look back period. So it's really up to you how you want to adjust your look back period and see how frequent you want to enter your trades. Okay. So I'm going to go through the steps in which you can use your stochastic indicator. So first and foremost, you need to understand how the trend is, right? What the trend is. Is it going up? Is it going down, or going sideways? Because in an uptrend, there'll be very little signals in the oversold period, in the oversold region. In a downtrend, there'll be very little signals in the overbought region, due to the fact that prices are going in the opposite direction. Okay, so you need to identify these areas first, the trend first, and once you have identified the trend, then the stochastic indicator can give you the confirmation to enter. Okay, in a sideways market, once you have identified a sideways market, then it's very easy, because basically whenever it enters the overbought region, you sell, and once it enters the oversold region, you buy. That's only for the sideways market. That's why I say that stochastic is very effective in a sideways market. In the uptrend and downtrend, you basically need to exercise a bit more caution to to enter your positions. Okay, there's a question on demonstrating the setup or combining it with corresponding time frames, SME on one asset. Okay, I'll do it after this. If you have time, I'll bring up the charts and then I'll show you an example. Okay, so I think this is the last slide. Okay, so the first step is defining the trend. Second step is to identify your support and resistance zones. So in an uptrend, you just need to identify your support zones, and in a downtrend, just need to identify your resistance zone. And once that's done, right, in an uptrend, you buy when the stochastic is oversold, and when price is in the support zone, and in a downtrend, sell when stochastic is overbought and price in the resistance zone. Okay, again, this is an example. Okay, so for this, some of you might look at it as a downtrend. There might be mini uptrend. So if in doubt, always use a higher time frame, zoom out a little bit, and make sure you are aligned in. You make sure you get the trend right before using the stochastics. Okay, so for this one, I'll identify it as a downtrend because it's defined by lower lows and lower highs. Okay, let me see if I can draw something like that. I can draw, yeah. Use pen. Okay, so this is my lower low due to the fact that there was a previous high. This is a lower high because of the previous higher high, and then this gives me a lower low, so on and so forth. Okay, so I identified this as a downward trend because this was the previous support, right? And it broke below. Now this becomes my resistance level. Again, this was a new support here when it bounced up, and then as it breaks down, this becomes my resistance zone. And then this level again, this is my support. Breaks down again, this becomes my resistance. Okay, so this I've identified this is my downtrend. First, I identified a downtrend. In my downtrend, I'll identify my resistance zone, which is these three lines here. And once this is done, I'll look at my stochastic, and I'll only sell when it goes into the red, to the zone that's highlighted in red. Okay, so maybe I'll skip this because this is my first zone. I'm unsure, so I will not enter this. So as price bounce above this level here, this zone is valid. This resistance zone is valid. So at this point in time, I'm in the oversold region. I'm not going to do anything because I already identified it as a downtrend. I will not be buying in a downtrend. Okay, so as price moves up, enter this region. This is my first opportunity to sell, because this is very close to my resistance zone, and it has entered into the overbought region. So I might sell here. Okay, then it goes down, and then once it goes down, I'm not going to buy here again because this is a downtrend. And then as it goes up into this region, I'll sell again. Okay, so if I sold here, I probably took profit here or took profit somewhere, maybe earlier. I wouldn't know. But again, I'll sell here again, and then basically ride the wave down here. As the price moves up, this did not enter my overbought region, so this was not a valid sell. Okay, but up to you on discretion, right, whether or not you were entered here. Then again, it broke down, it formed a new low. Now this is my new resistance. So I wouldn't wait for price to go up to this particular resistance because I already identified a new resistance which is lower. So as it enters into this region, I'll start selling, right? So this whole part, there might be stop loss being triggered, but nonetheless, if you keep your sell positions here, right, then basically as price goes down, you would have made profits. Okay, then again, as it comes back up here, this is the overbought region, but you can see that price is nowhere near my resistance zone, so I might not have sold here. Okay, I will need prices to go back up to this level before considering it as a valid sell. Okay, and it goes down in the same thing again. Okay, so for 1 hour time frame is 14.55 good. So if you're doing a 14.55, your intervals is basically trading on a 5-hour interval, which is valid if you're trading the London to New York session, and you're looking at a 14-hour look back, which is half a day. Would that be, you get a lot of signals, I would say, right? Yeah, but definitely valid, yeah. So maybe we'll just use one example. Let's see if there's another slide. I'll go through this slide first, and then I'll go into a real life example on the hour time frame or the daily time frame, or maybe somewhere in between, like 4 hours. Okay. So one thing to note is during a strong bullish or bearish trend, right, your stochastic may not enter into it wouldn't be so nice to enter into these regions here. Okay, so 2 steps to actually readjust your look back period and to fine-tune your stochastic parameters. One is that you enter a lower time frame to detect the change in the direction. Okay, so if on the daily time frame you do not see any of the your stochastic or your SMA lines entering into the overbought or oversold region, then it might help for you to actually lower it down to the 4 hours or the 1 hour. This is basically just to increase the sensitivity of the price to your stochastics, for you to get more signals to enter. Okay. The other way, like what I've mentioned earlier, is to reduce your your K value, which is to reduce the size of the intervals such that any movement will be captured into your stochastics. Okay, so if you're using like 48 on a daily time frame, 48 days is basically 2 months, right? So the chances that your stochastic actually enters your oversold or overbought region, it's rare. Whereas a 48 interval on 5 minutes, your look back is basically 4 hours. You might see more entries or more signals occurring on a lower time frame. So 2 things: lower your time frame or reduce the look back of your, or reduce the K period. Okay, the value of K in your stochastic. I think there's 2 more examples before we go to the live charts. So I've used this example on USD CAD, 4 hour versus 15 minutes. So the 2 steps, right? If you compare the 4 hours, same K values, same SMA and D values, right? And the 15 minutes. If you look at this stochastic chart, you'll realize that at most you get 2 entries, which is again, we need to define the trend. So I identify this as an uptrend from here onwards. Okay, from this point onwards, right? I'll consider this as an uptrend. Okay. So in an uptrend, I'm only looking at anything below the 20 period. So from this point onwards, this is one entry and this is the other entry. This is on the 4 hours chart, right? So I would have entered here, I would have entered here. Okay. And each entry is roughly 1 month apart. So you look at 4 hours, again, a 48 period of 48, if your K value is 48 on a 4 hours time frame, your look back is in fact 6 days, which is roughly a week. Okay, and when trailing 1 week look back, and when that happens, you will see that your entries are roughly 1 month to 1.5 months apart. Okay, your entries are lesser, but they are more accurate. Okay, but if you drop this 4 hours to a 15 minutes time frame, you'll realize that same chart right now, but I'm getting more signals. Again, I only look at values that are below 20. So just by reducing your time frame of the chart, you can increase it by 1 additional value. But that doesn't mean that your entries are always accurate, because this additional entry that you have entered, even though you have made money, but it would not be as effective as this two, right? So if you help this is probably like 300 pips, this might be another 500 pips. Whereas for this might be just say a 50 or 100 pip move only. So you get more, you increase the frequency of your trades, but the value or the quality of the trade might not be as good. Okay. And then again, this is also a continuation of that 15 minutes. 15 minutes, right? Both are 15 minutes, just that this looks at 48 look back, whereas this is a 16 look back. So in fact, this is my intervals right now has been reduced by reduced 4 times. So this is 25% of this. Basically, we are looking at the same time frame. Anything below 20 from this area onwards, we have 3 entries here, right? This is the same as the previous example. 48 period look back on a 15 minutes, you're basically looking back at a 12-hour interval, whereas a 16 K value, you're just looking at a 3 hours interval. Okay, but just by reducing your K value, you have one additional entry here, which is this value here. And so you would have missed this value here, right? So just by reducing your K value, you have one additional entry to enter this by. Okay. So these are the 2 methods that we have talked about. Okay, I'm just gonna go through quickly on a real chart so that you can see how it works. I'm just gonna use something easy like euro dollar. Okay. And then so first and foremost, let's look at the daily time frame, right? And then just remove everything else. Okay, on a daily time frame, suggested will be 12.33, right? So what this means is that I'm looking at the current price to what happened 12 days ago, and 12 days ago is roughly 2 weeks ago. So any events in the 12th week, I can for certain say that at this point in time, because this value is right now it's 15.41, which is in my oversold region, I know that this price here, as compared to 12 days ago, it's much lesser. It's on at around roughly the 15th percentile of the price 2 weeks ago. So is it an opportunity for me to buy? Not just yet, but this is a signal for me to stop selling, right? Because for the past 12 days, or if I compare my current price to 12 days ago, right? I'm already at my 15th percentile. That means there are a lot of sellers who are making money. If I were to enter a sell right now, I'm basically one of the lead sellers. But again, I don't want to be an early buyer unless the market tells me so. Okay, so same thing, define the trend. We are not going to buy in a downtrend. So this is basically from here, it's basically a take profit signal or a signal to stop selling. Okay, the 3 days SMA basically looks at my stochastics for the past 3 days, the average of the past 3 days stochastics, and it basically smoothed out my blue line. So you look at the blue line, it's very edgy, right? It's very sensitive to the prices, whereas the orange line is much smoother and tend to give us lesser false signals. Okay, and again, conventionally, as the blue line moves above the orange line, it means that it's an indicator to buy, indication to buy. Okay, but for us in a downtrend, we do not buy in the oversold region. So what happens if I increase this 12 period, right? To instead of a 2 weeks look back, I want to increase it to a 2 months look back. Okay, so that means I will need to increase it by 8, which is 12 days is 2 weeks. I just need to increase it by 4. Let's say I do 48. Okay, what we'll see is that right now, instead of a more frequent signal wave, right, you can see that it dropped from, just now there were a few signals here, it dropped down to just maybe 1 or 2 signals for me to sell. Why is that so? Because right now, what I'm measuring is the current price against what happened 2 months ago. Okay, so what happened in September right now versus what happened in, say, July, right? And usually if such major events that can create such a big move are usually the sort of like big events or big movements by the central bank, more fundamental related, but I'm not going to touch on that. But we do note that this high here, 10th of February, is when Russia invaded Ukraine, right? Roughly around that time. So that was an indication for us to actually sell the euro dollar. And if we were to use 48 on a daily time frame, you'll notice that since February, there isn't any signal for us to sell. Because again, we want to make sure that we are actually highlighting this area. We are only selling above the 80. Okay, so no signals for the entire year already, which means that you don't get to have any trades or any profits for this period. Okay, but if you want to use 48, let's just move down one time frame, right, 4 hours, and see what's the number of okay, so just by moving down one time frame, right, and I'm going to mark out February the 8th, which is where we had the daily signal. You'll notice that you have an additional 1, 2, maybe this whole thing is 3, 4, and then 5, 6, 7, 8. So from one signal, now we have 8 different signals. Whether or not these signals make sense, again, if you look up at this value, you have sold here, you will have sold here again, you have sold somewhere around here, you have sold again here, and all of these are all profitable, right? Okay. We have sold here, which might have zigzag for a period. So this tree might not get as much profits as the ones prior, but again, this value here, again, you would have sold. So from one signal to 8 signals with the same K back. Again, 48 on the 4 hours, that would be 8 days, which is 2 weeks intervals. So you went from a 2 weeks intervals to an 8 days 2 months intervals to an 2 weeks interval. So just by reducing the time frame, you're increasing the number of signals by 8 in this example. And of course, if I go down to the 1 hour, then you will have even more signals coming in. Okay, so increasing the frequency will decrease your accuracy. Okay, increasing the frequency will lead to a decrease in accuracy. But that's if your objective is to increase the number of trades, right? Otherwise, use the higher time frame, because increasing the time frame will increase your accuracy but decrease your frequency of trade. Okay, the ideal scenario is to increase the frequency of trades as well as increase the accuracy of trades. Then basically, you'll make money no matter what, right? But basically, they are inversely related. So as you increase one, the other will decrease. In data science, you usually compare that as the sensitivity versus the precision versus the sensitivity. Okay. So again, if let's say we go back to the 4 hours, right? I have 8 signals, right? So I'm just going to clear all of this. If I were to change from 48, so instead of a 2 weeks look back, now I'm just interested in say 3 days, right? So on a 4 hours, one day there's 6, 3 days that we 18. So if I change it to 18, right, you also increase your frequency, right? So again, I'm gonna mark out my 80 point here and basically increase the frequency where your stochastic goes above. Again, I'm not interested in anything below 20 because this is a downtrend. I've identified this as a downtrend. I'm only interested in sales. Okay, so let's look from say here onwards. Okay, so this would be an accurate signal. This struggling to go above 80, but I would take that as a valid signal as well. This as well, and then look at this. Let's zoom into this example here. Okay, so when it comes to this level, you realize that if you were to sell at the first signal here, and then another one here, another one here, right? Or maybe not the last one. Okay, so you notice that only the last two will actually be accurate, in a sense that once you have entered this, you will not have suffered the drawdown. But if you would enter this field here, you have suffered a drawdown if you were to keep the positions, or you'll be stopped out if you were to place a stop loss. So the good thing is that if you have identified your trend, then your drawdown would have been roughly about half a month before you get into profits. This is a common sight for those Greek traders. So basically, they sell at certain intervals, and as price moves down, they profit from this hold up. Okay, but why is it that this went into the overbought region, but in fact, like, cause people to be stopped out or suffer a drawdown? Okay, so this value, again, this is a perfectly right overbought region. Why? Because there's this downward move. The expectation is that it hits this point and goes down further. Just that somehow price managed to move up, and it's not 100% move. You wouldn't know that price would have moved up. You wouldn't know that price would have moved down. But at this point in time, you would definitely have sold as a seller, because this was the new resistance, and you have sold to push price down. Okay, so again, as you increase the number of frequency, there will be scenarios where your accuracy will drop, and this basically highlights the problem of using a more your K value as a lower K value will give you such false signals. But again, two things to note: if you are trading with the trend, ultimately, right, you would have averaged up your sells and be profitable somewhere around the mid region. And secondly, if you do not want to, if you're not someone who is in front of the computer for like 10 hours a day, right, you will want to trade the higher time frames as well as a more sensible K value. Okay, so if I return this back to 48, okay, you will notice this value, this is no longer a valid sell, but this other field will be still valid to sell. Okay, so again, you have lost this value, you have lost this entry, but this is still a valid entry. Okay, so you reduce these three entries while maintaining a higher accuracy rate with this. You have failed maybe at these two levels, right? Again, this is when it first crossed over. Two ways to trade this, right? So when it first crossed into your overbought region, if you're aggressive, you will have sold then. Otherwise, you would have waited for the orange line to fall below, from above 80 to below 80 before you start selling. So this would have been an entry. This would have been an entry. And if you look at the corresponding price, it would have been these two values here. So here again, here, and then again here. The second one would have cost you to, and if your stop loss is maybe above, somewhere around here, then both entries would have been in profit. Okay, so just these two things, like reducing the time frame to increase your frequency, or reduce the K value to increase your frequency. If you want to go for more accurate signals, use the higher time frames, 4 hours daily. Anything above that, you will get very infrequent trades on a weekly. If I zoom this out a little bit, the start of my downtrend, right? I wouldn't know this is a downtrend maybe until, say, the break of this structure here. And then if I were to mark it, you wouldn't have gotten any entries if you were on the weekly time frame. And so this would have been a 2000 pip move without any entries for sell. So you go down daily, you might have 2 entries, and then you go to the 4 hourly, you might have more entries here. Okay, so that's kind of like the idea. So with that, right, we've basically covered like stochastic. I think stochastic is kind of a very common indicator that everyone uses. So I'm not too worried that like any of these concepts is will be foreign to you guys. But what I've learned as a when I'm coding for such a strategy with stochastics is that these are the steps that I will basically take, right? So defining the current trend. So if you were to code this, or if you want to make this strategy a consistent strategy, right? Basically code it out such that the algorithm will always adhere to all of these conditions, right? So you have to identify if it's an uptrend, downtrend, or sideways. If it's an uptrend, once you have identified the uptrend, define all your support zones. If it's a downtrend, identify all your resistance zones. So once price enter your support zones or your resistance zones, and it goes above your stochastics goes below your goes into your overbought region, that's where you start to enter your positions. Okay, and then last but not least, tune the look back period to the market open cycles. Okay, there's a question on the second and third parameters down there. Okay. So if you look into this, so there's a K length, there's a K smoothing, and there's a D smoothing. Okay, so your K length is basically your look back period. So, what are you comparing from your current price? What's the number of look back periods that you want to look to see? Okay, and because this is only a single point measurement, it is very sensitive, right? So what the analysts usually do is we want to smooth out this curve. And basically, how do you smooth out the curve is usually use an average. So, so say for example, in the past 3 days, I have 3 values, and each of these days I'm comparing against 48 days, the price 48 days ago. So let's say I have a 20.36, I have a 28.7, and I have a 30, right? So this is a very sensitive value. So what the orange line is measuring is finding the average of these 3 values for the current day, right? So you're just finding the average of your stochastic values for the previous 3 days. Okay, and then D smoothing is basically the smoothing of your K smoothing. So this value that you have derived from your K length, you're going to average out that value again. So the average of an average. Okay, but you don't have to go into the details of the calculation, but what it does is basically to smoothen out this value. So maybe I give you an exaggerated. So if I were to do this at 1, right, what do you think will happen? Right, if I change this to 1, if you look at the blue line, right, it becomes very sensitive to your price changes, which if you were to overlap it, you for any black candle, it will basically move the blue line down. Any white candle, it will move the white line up. So if you do this, right, you have a lot of signals. But do you sell on every of these signals? You wouldn't, right? So basically, this first K value has to be an appropriate value on the look back that you're trading. Okay, so if let's say I do like this becomes very sensitive. There are a lot of pointy edges. When I change it to 12, it smoothens out the blue line. Now, if my K smooth, I'm going to make it 12 as well. See what happens. It becomes even smoother. So I don't have any pointy edges. It becomes less sensitive, right? Maybe when it's 12, you only get 1 entry, but if you reduce this to 1, you get multiple entries within that one curve there. So more entries means less accuracy, right? So you want to make sure that your accuracy is at a value that's high enough such that your expected outcome is positive. And again, this is the smoothing of my previous my K smoothing. So if I would change this to 5, you see that your orange value is smoothened out by a bit. And if I were to do this as 12 as well, then basically it's like you see that it's more rounded and it's not as sensitive as the blue line. Okay, so maybe I give you an example. If I were to mark out the 80 point here, right? Okay, so you see that this the K value here, right? If you were to base off the K value, you would have sold this, right? But because of the smoothing of your K value, your orange line is below your 80 value. So this wouldn't have been a valid sell. So it reduces your frequency, but in return increases your accuracy of your trading signals. Okay, so if this blue line is above, this orange line is above, then this becomes a valid sell. Okay, so that's kind of the way. I think the key thing you want to take note of is you can keep the smoothing as 3. Just make sure that the K value is of an appropriate length, depending on each individual trading preference. Okay. I hope that answers how you can actually tweak these 3 values, right? The main thing is the K value, and then the averages of the other 2 will be the averages. Yeah. Okay. That I hope I answered all of your questions on stochastics trading. I think the key highlight I would say would be this 4 points here. So defining the trend, defining your support resistance zone, and then the confluence of your stochastics into those zones will be how we can identify good entry points using stochastics. Okay, so this is an oscillator similar to your RSI oscillator. So if you are trading stochastics and you're trading RSI as well, they are basically the same thing, but with different threshold levels. Just note that for RSI it's 70 and 30, stochastics 80 and 20. And again, these are all guideline parameters. If you think that it's more effective to be 60 or 40, 95 or 5 to be more accurate, you can do it as well. No one's stopping you, as long as you follow all these guidelines. The values can be anything. The parameters doesn't really affect. It's going to be like a 5 pip to 6 pip difference in terms of entry. You might lose 1 or 2 signals if you make it too if you make it less sensitive. But other than that, it should basically give you the same outcomes when you're trading. Okay, so with that, I guess that's all I have for stochastics. If you want to look out at some of the previous webinars that we have, there is one on the different oscillators. So we also talk about moving averages, the MACDs, moving average, convergent, divergence indicator as well. Feel free to visit this website, vantagemarkets.com/webinars, to find out more about the other webinars. And if you have any questions regarding trading on Vantage, this is the email to support@vantagemarkets.com. Okay, with that, thank you guys for coming. I hope to see you guys soon again on the next session tomorrow. All right, thank you guys.